Good after morning to everybody. It is a little afternoon on Monday, July 25th. I'm Kirk Spano, and as usual, I'm running a couple of minutes late. Just want to make a quick announcement. I will be at the Money Show on Tuesday doing a presentation on really the future of energy and how the clean energy transition has accelerated due to OPEC and Russia, but also there are more wildfires on the planet than in history, of recorded history. And I think that the entire realization that we have a bit of a problem is starting to hit more and more people smack dab in the head about the climate change that we're seeing, the rise in temperatures. So I would expect that will be one of our major themes for a very long time, along with onshoring, digitalization, and decentralization, really the whole fourth industrial revolution. So our big secular themes are clean energy and decarbonization, onshoring of vital industries back to America and really North America. That's how supply chains will manifest. And then the fourth industrial revolution and everything that it entails with decentralization and digitalization. So when you take a look at the stocks that I'm recommending, they're almost all from those major categories. When we take a look at everything that's coming, it's biofuels, it's green hydrogen, it's clean energy, it's carbon capture, and it's energy storage. If we can accelerate all of those things and get them working together, we've got a shot at not burning up. And that's nice. We have a chance. And so that's hopefully something that we can focus on here in the next election, to be honest with you, because after what I've seen being in the Southwest of this country, man, anybody who doesn't think that we have a climate problem is just not paying attention. I can't be more diplomatic than that. They're just not paying attention. The sea level rises around the world are threatening cities. People say, oh, well, I saw a stick and, or a bridge, and it doesn't look like there's sea level change. It's a 50-year-old bridge. Well, talk to the mayors of New York and Miami and any coastal town, and they'll tell you the problems that they're having. I was just in Door County, Wisconsin, and the Great Lakes are, I don't even know the number, but the Great Lakes are really high. So, there's water everywhere right now. Now, does that reverse at some point when the polar ice caps have mostly melted? I don't know. That's above my pay grade. What I do know is that the pressure on coastlines, where most people in the world actually live, most people in the world live close to a coastline. That's the interior of the country that I think is going to do much better, especially the Great Lakes region, where you can get the water, but you don't have to live right on the water. These things are changing very fast. So that's a major theme that you'll see in the stocks that I pick out. If you just can't get enough of listening to me, this article is actually half written already and the presentation's mostly done. So it will be on Seeking Alpha. You don't have to come tomorrow, but it is free. I'm also teaching a class based on our 4-step process. You don't have to pay for that. I will do that here for free as well. But if you'd like to see this presentation ahead of time, you certainly can do it. So this week, I took a look at our companies on the plug and play list, and I wanted to find companies that were really something that we should be paying attention to right now. Focus stocks that I think have a great future. Some of the ones that look like they're kind of in double or triple bottoming processes that have anywhere from the ability to triple quickly to be 10 to 20 times return companies in the next decade are really what I'm liking. But, we have several dividend stocks that look pretty amazing too. One of our dividend stocks, Ford, I think that could be a 10 bagger and it's a dividend stock. So there's a lot to be said about getting involved with these companies and scaling in before and after whatever it is the Fed's going to do next. Larry Summers, of course, is pounding the table, and Ilarion is pounding the table. There's a lot of Austrian-style economists, or just those who want to make a prediction, I guess. And I don't necessarily agree with most of them, but I don't think the Fed needs to be much tougher. I think that the economy is slowing down. Door County was not as busy as it usually is in July, which is the complete opposite of Vegas. Vegas was off the charts. And just a month later, it looks like things are slowing down. The price of gasoline in Wisconsin is down about 20% in the last month or so. Inventories are up. The manufacturers index was below 50. And historically, the Fed backs off when it gets below 50. So I think that we are having what I called a skip straight recession a couple of years ago. I believe what we're seeing is periods within the year that get slow. I don't think that we're seeing an overall huge slowdown in the economy, though. And I think that we're running hot and we're just getting back to warm. And I'm not so sure that we're going to get much below warm. Maybe we'll need a windbreaker, but I don't think that you're going to see the horrific recession that a lot of people are forecasting. I think if we get anything, it'll be short and shallow. I think that the skip straight recession is here, intermittent periods of slower economic growth or very mild pullbacks. I think the first quarters are usually when you see it, but you might be seeing it here in the third quarter as well. So if we get first, third, and first quarters sequentially being slow or slower at least, I think that probably is going to satisfy a lot of things. The thing to worry about, right? One of the big themes is onshoring, and getting supply chains to move means that capital has to be able to move pretty freely. Can't be too tight over at the Fed. So while I think they're going to do 75 basis points next couple days, I think there might be some sort of a fig leaf offered. And the fig leaf, I believe the Fed will probably offer, if they offer one, is that they're going to wait until September's meeting to determine if they're going to increase the runoff in the balance sheet. We'll see. I don't think that they need to go much higher or much tighter. If they do, the consequence could be stagflation. So we could go from a good economy with inflation to a bad economy with inflation. That's not what we want. We want these supply chains to move here. We want to get further along in the clean energy transition so that oil can't cause as much inflation. And housing prices are already starting to come down. The housing project that I'm working on gets good and bad news depending on the day. I do think that I'm going to have to buy the property outright. So I'm going to have to write a check for $2 million. I'm not really sure how to do that without really doing some serious liquidations and paying some heavy taxes if I do it myself. So I might, I don't know, I might have to find a creative deal for that. In any case, the mayor in the town is an old man and, very want to keep it pro agriculture based in this suburb of Milwaukee. And the backward looking approach is pretty off the charts to me. When I approached them and said, look, we're not going to even hook up natural gas to the subdivision, he looked at me like I was crazy. I was like, it's cheaper to build our own solar microgrid than to install the natural gas. Well, that can't be. I was like, well, then invest your money and buy the property. I didn't say that, but I tried to make it very clear to him that starting from scratch, it is cheaper to have a solar microgrid in a subdivision than it is to install the natural gas. I mean, think about that. Would you even have imagined that was true 10 years ago, or that it would be true in 10 years from 10 years ago? All these trends that I keep talking about, they're moving faster and faster and faster. So what would I do right now? Well, with options, remember the things that we talk about. That should be high. That should be a header. I want you to take a look at puts that will get you into some of the core theme stocks. So these are the ones that are close right now. Is it 11? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 stocks. If you already have these, you should consider, do you have more room in your portfolio for more of these, for more of an asset allocation to any of these? If you don't have a starter, I think you should consider taking a starter in all of them. I think that every one of these stocks should be in every single person's portfolio, retiree or growth investor. That's how I did this list. We've got like 70 new subscribers. Folks, start here. This is where you can build a portfolio. These are well diversified and will give you an all cap approach across most of the major sectors that are going to benefit from the changes in the economy that are already happening. Ametis. I'm going to go through the trades. Remember, these prices here, the premium prices, are oftentimes a little higher than what you see right now. You want to benefit from the volatility by setting a good till cancel order. And always set your good till cancel order above what you're trying to get. So if the actual price that this is trading for right now is 75 cents, put your order in at 90 cents or a buck. See what happens. See if they start moving towards you over the course of an hour or two. Then you can always walk it back. So it's going to take some effort to get these trades executed if you want to get the very best price. Set it and forget it, like I've told you over and over again, is a lazy person's way of investing. And as much as we all want to be lazy, it's not the smartest way to invest. Set your limit prices above what's being asked for right now, and then walk it back. And it might take a day or two. So let's take a look at some of these. Ametis, you are below bottom fishing prices. You're starting to get huge accumulation in here. Somebody's buying that. That's why it's moving sideways now. The short position is starting to fall apart. They are projecting revenues and have contracts for most of it already of well over $5 billion through 2026. And their CapEx is going to fall off the charts by then. So they're in their CapEx period. This is a very classic pattern, right? 1, 2, 3, 4, 5. Classic correction pattern, soaking up time. You need to be in this stock. A similar company, another biofuels company just got bought. That's a fraction of the size of this one, just like the one in Iowa got bought a few months ago. These biofuel companies that have refining capacity, and these guys, remember, have carbon capture and India on top of that. This is going to be a big company. $5 billion. I can't stress it to you enough. This is heading towards $5 billion of market cap. When you take a look at normal ratios that manifest, price to sales, price to revenue, EV, all those things, a normal price for this stock would be around $5 billion in market cap by the middle of the decade. And it's a couple $100 million right now. Ford. I like this chart. It's going to probably double bottom here again. Could it fall down all the way to 8 or 9? Absolutely. Shooter thinks that it could in a bad market, but you should be looking at Ford right now. What people don't understand about Ford is not only is a part of the great onshoring of supply chains back to America, but it's also a clean energy decarbonization story. And what the market completely misses is a real estate component. So not only are they building a gigantic factory in Kentucky, and they've worked out deals on lithium and batteries that they're going to produce 600,000 EVs next year. Quite the jump, right? They're going to double their production and sales in 1 year. Car company doing that. The real estate component, just for those of you who haven't heard this before, but we've been talking about this for 2.5 years. As companies shift from internal combustion engines to EVs, they pick up 30 to 50% of their floor space again, because it doesn't take as much room to build EVs. The supply chains are going to be different. So what you're going to eventually see is Ford with a whole bunch of industrial real estate that they can sell into a market that needs it, or they can use their fourth industrial revolution technology, which is among the very best in the world, and produce other things. And I think that's mainly what they're going to do. I believe, and for those of you who have always looked to make more money in different ways, Ford is going to end up having multiple streams of income, right? You've heard that phrase before. They're going to become more of a conglomerate. Tesla is already a $500 billion company. Ford is 1/10 of that. I'm telling you right now, Ford is going to beat Tesla. Ford is taking care of their legacy issues, and they have a ton of real estate that Tesla doesn't have. So where in the past people said, well, Tesla doesn't have legacy issues, they're growing into their legacy issues. What did Musk just say about Tesla's growth? That his new factories are all money pits. So don't expect Tesla to do much more than chop around for a while, in my opinion, until they really get into solar installations, if their product can come to market, right? The solar product from Tesla is pretty awesome if it works and if they can get it installed. I think that Tesla is going to probably have to open dealerships again. So there's a lot of CapEx coming from Tesla. So it just depends on the issue of each company. I think Tesla's fully valued, and they'll accomplish all the things that they've talked about, but it'll take time, but they're fully valued, give or take. Ford, I think, is undervalued, by a tremendous amount, and they're already paying a dividend and looking at buying back shares. Remember, Ford still sells a ton more cars than Tesla. And I believe Ford's going to end up being the EV leader in America. The Mustang and the F-150, which is already the top selling car, are awesome. They are off the charts good. So there is no real technological difference between a Model Y and a Mustang. They're different cars. But from a technology standpoint, I don't know that you can tell the difference from a technology standpoint. They're pretty darn close. And Ford's a better looking car with a much larger group of people who are interested in buying it, right? Legacy customers. That's one of the benefits of having legacy. All kinds of people who call themselves Ford people. Somebody asked about Intel, which is not popping up. So we'll do it this way. So you've got Intel, which is about to get a bunch of money from the government. Just to wrap your head around this, we need 10 times more semiconductors to build out the Internet of Things and the clean energy transition over the next decade. Intel is going to become a platform company, a lot like Taiwan Semiconductor, by producing semiconductors for various customers, right? Not an Intel semiconductor, but somebody else's specific design that the fabs that Intel is building will be able to make. And the government's going to defray the cost of that. So Intel, which already buys back shares periodically and pays a dividend, is a company that should end up getting to be as big as Taiwan Semiconductor and becoming a duopolist in that industry. Remember, we like oligopolies and duopolies. We love monopolies as an investor. It's not good for consumers, but in this case, we're going from one big company that was making semiconductors for everybody to two. So that'll at least be a little bit better for consumers. Intel, I think, is a pretty easy triple to get up to around $500 billion market cap, which is similar to Taiwan Semiconductor. So if you're a dividend investor, Intel's an easy one. You buy it, you collect your dividend. When it gets to around $500 billion, you'll have a decision to make. I think that's 5 or 6 years out. It's not forever, but it's a pretty long time. So I would say, hey, if you're a dividend investor and you want something that's basically government backed, super safe, is in all the great growth trends, right? Semiconductors are fourth industrial revolution components, buy Intel. I have a starter position. I might sell this option as well. MP Materials, clean energy. We've been trying to figure out where the bottom is on this. We may have seen it, but if I had to guess, I'd say we're probably going to see a price in the 20s one more time. Not a lot of risk here. The company keeps outperforming. Again, if you don't know the company, always take a look at the presentations. Don't rely on me to tell you what the company is. I don't need to regurgitate that. Go learn what the company is by looking at the corporate presentations at the investor relations website. My job is to tell you why they're mispriced, what the market is missing. And what the market is missing here is that the magnet component and the processing components of this company are massive. They're going to have huge potential. I don't think it's very hard to see this company doing $4-6 billion in revenues, up from 166 million within the decade. Everybody wants to talk about, they're getting rare earths. Yeah, but really the big deal is they're going to start processing them here instead of sending it to China and then back. Think about the cost savings of doing it here. You eliminate all the transportation costs. There's a half a dozen other rare earth metals mines coming online in North America, and those can get sent to MP Materials as well. And then when they start doing the magnets, which are important for wind, but also EVs and hybrids, companies should jump. I believe it'll be an S&P 500 company in 3, 4, 5 years, right in there, maybe 6. Hard to know. With the EV companies, with Ford and GM ramping up, shooting for 2027 for their big ramps, getting to be full production by 2027 for Ford and 2030 for GM. MP should probably move a year or two ahead of them because of the orders they'll get. We'll see. They'll be pretty close. But MP Materials, based on current market cap to where they should be by the end of the decade, it's not hard to see them being a $50 billion company, but I think $25 billion is pretty easy. I have a hard time not seeing them as a 5-bagger, but I think they make a run at a 10-bagger from here. And remember, this is one of the SPACs that we bought pretty cheap. And I'm telling you, probably, after all this chopping around, we're looking for a bottom right now. SunPower. I continue to focus on SunPower because remember, they have a strategic investment in Enphase, and they are majority owned by Total, which is one of the oil majors. They are putting in a pretty strong bottom. See how they've been chopping around now for most of the year. I believe that based on conservative estimates of their revenues over the rest of the decade, ramping up in the middle of the decade for sure, easily a $25 billion stock. And this one I could see going to 50 billion as well. Huge upside and limited downside because of their strategic partnerships with Enphase and investment in Enphase. There's an easy way to get an investment in Enphase. Between the ETFs and SunPower, you have a pretty good position in Enphase. So you don't even necessarily have to own Enphase directly if you don't want to. Or you can just have a small position in Enphase because you're getting it different ways. Square, complete round trip. It's at its bottom fishing price, starting to get big interest in here. Once it breaks out past about 125, maybe 140, there's a new breakout on, and it'll go all the way back up to its highs. Now, whether it goes past their old highs is going to be very dependent on Bitcoin, but it's easy to see it returning to its highs in the next 5 years, 3, 4, 5 years, which is a triple to quadruple. Could it go down a little bit more? Sure. That's why we're selling puts and taking small starter positions. Unity, people are completely missing what this company is. It's a platform company for the metaverse and virtual reality and augmented reality, which has heavy applications in industry. It's putting in a bottom here. It's below bottom fishing prices. I own this stock and I already have puts sold on it. But the metaverse, they're having a hard time putting estimates on what it'll be in the next decade. That's how big it is, because it really is going to affect everything. The fourth industrial revolution, it's not just going online to shop differently. It's how you run businesses. It's how you use augmented reality to do something or build something or fix something on the fly because the AI is helping you through some sort of an interface. The applications are tremendous. I've seen 10 trillion, 20 trillion, 30 trillion, 50 trillion. I mean, nobody knows how big this can get for the total addressable market. But Unity is one of those platform companies that we've talked about over and over again. It has the potential for massive upside. As it rises again and it gets past about 85, this zone right in here, it'll break out, probably run all the way to close to 200. And then at that point, who knows, probably jitterbugs. But I think this is a pretty easy 5-bagger from here for the next several years. Something a little bit more boring, but because so many of you own it, everybody's pulling their hair out because Warner Brothers just keeps falling. Well, it looks like it's leveling off, starting to get pretty big traction again. And as it goes through here, which will be an accumulation phase, if it gets past about 35, it can break out again. Now, here's the thing that people don't understand about most of these streaming companies. In the future, they aren't going to be what they are today. They're going to be able to hold their cost about the same, and their distribution around the world is going to continually increase. And you probably have one more big consolidation deal here in the United States. Depends on some of the personalities involved. But if that consolidation happens, then pricing power goes up. As linear TV goes completely away in the next 5 to 10 years, and everything is on some sort of a platform, Comcast can basically, and AT&T can basically offer the same sorts of services as Roku, which is why I think Roku is having a hard time finding a TV provider. Because all the things that Roku does, which I love, can be done pretty easily on a Fire Stick or right on the wire of your cable provider, of your Wi-Fi backbone, right? Whoever's providing you with your bandwidth. That's why I'm not so fond of Roku. So I think they got out into a lead, but I think it's an industry changing so fast, they're going to have a problem, which is why I don't want Netflix to buy them. So all of these stocks on this list, these 10 companies, there are big reasons to be involved. They pay a dividend, they pay a dividend, they pay a dividend, and they pay a dividend. Oops, take that back. Warner Brothers Discovery does not pay a dividend yet, but they're talking about it. Ford, Intel, Paramount all pay dividends already and have huge upside. Low risk, beaten up. If you really consider yourself a value investor, a buy low investor, these are stocks that you should be involved with. And I think that everybody can own at least a little of the growth stocks, even if you're retired. Maybe just sell the puts if you're retired. Everybody else should own them. Speaking of Netflix, I did decide to sell my entire position because I am afraid of how consolidation might impact them. I think if they buy Roku, they're making a mistake. I think if they get into bed with Comcast and NBC or with Paramount, I think it's more likely to be NBC, Universal than Paramount. They have massive dilution and they have to take on some debt. So I think that Netflix is a great company. I can't be without them, but I think they're a much better buy at 50 than they are at 225. So I bought them in the 170s, just sold them out completely, and it's definitely a trading stock, but I don't think it's a buy and expect to triple or more your money in the next 5 years stock. So I did get rid of my Netflix, took the profit. I sold some covered calls on Marathon. So if anybody is trading their Marathon, fine. But I also think that you want to keep some of it. You don't want to trade out of all of it. What else? What I sold a covered call on. What did I sell a covered call on? I'm looking. I mentioned it online. Oh yeah, Azure. You're right. Thank you. I sold a covered call on Azure, and the reason I did it is because there wasn't much of a market on selling the stock. Me trying to sell a few thousand shares of that stock moved the price, but the option premiums were still out there on the 1250 calls. So I'll add that onto the bottom of the article. If you had Azure put to you at 1250, and I think the premium was $1.25, you can sell a 1250 call right now on Azure, even though the stock is under 12, and get about $1.25 again. So again, I didn't sell cover calls on the entire position. I want some of it to run if it runs. And I think that this chart needs some updating for sure, right? I think 13 is a pretty solid bottom. Starts picking up a lot of shares right in here. That right there, double top. Okay. Yeah, okay. So that line was right. The bottom was lower. All right. So, you can hold on to it to let it rally. Then maybe you sell a more expensive covered call. But remember, I'm managing other people's money, so I have to be a little bit more conservative in general. Most of you can be more aggressive than what I talk about. So you just have to measure where it is you think that you want to be in your asset allocation. But I liked selling the 1250 covered calls because I got $1.25, and I already had $1.25. It's a 20% gain in a few months. I can live with that. All right. Any questions about any particular stock? Anything that you're invested in that you want to talk about? TDoc. Yeah, that did not get put to me. Forget how. Yeah, I think that's that's pretty solid right there. It's basically at bottom fishing. See all that volume here? It should go through here pretty quick. I could see Teladoc being 70 by the end of the year, maybe, or early next year. So yeah, definitely you could sell puts on Teladoc. What puts would we sell? One moment, please. And I really think this is going to run to about 50 something pretty quick. Yeah, you probably sell the $45 puts. If you're looking to actually get it put to you, sell the Septembers. If you're just trying to lower your cost basis, go with the Decembers. So September or December 45s, depending on if you're trying to get it put to you or if you're just trying to lower your cost basis. If you're trying to lower your cost basis because you already own it, sell the 45s for December. So you get like $10 for those. And if you're trying to get it put to you, then sell the Septembers, which you're gonna get $7 for those too. Yeah, I'm gonna add these to the article. These are pretty obnoxiously cheap. Good catch on that one, Rodney. Anything else? Jumia. So Jumia, right, is a moonshot stock. So I'll just do that chart over. In Africa, pretty much hit that one on the head. Oops. Honestly, if you already own it, you just want to lower your cost basis, then go ahead and sell some December puts, $5 December puts. You understand why I'm saying that? It's basically at bottom fishing. You're getting a lot of time value because it's December. Oh, that was right on the nut. That was pretty good. All right. Sometimes I redo the charts and I'm like, oh, that was a pretty good chart. Again, I think I can see this one running up to 15-ish by next year. There's an awful lot of good stuff out there, I'll tell you. These small caps, I think, are really just a generational opportunity. Yeah, I'll add both of these. That's a good catch, too. This is more speculative, though. It's based on a development in Africa. And a theme that I've talked about before that we can keep talking about. I'm going to write an article about it after I do the money show and after I hear what the Fed says. The dollar, like I said, 2-3 weeks ago, it's getting close to, stopping going up. Will it chop around for a little while? Sure. But ultimately, the dollar is going to have to come down a little bit because you just can't have the global economy in this much turmoil. We're going to have to allow time to fix things. We can't force inflation down because it's largely supply chain driven and energy driven. It's just going to be a function of time. If they get more aggressive and cause a recession, then we have to start thinking, Armageddon zombie apocalypse, because stagflation. I mean, if Jay Powell pushes us into stagflation, it'll be the dumbest move in Federal Reserve history, bordering on evil, because there's just no point to do it. And all the people who are inflationistas and they've been pounding their chest about inflation for 40 years when it wasn't here, that are having their moment. It's just a clock going through their position twice a day. That's all it is. They're not right about anything. This is a unique circumstance, largely caused by COVID and the response to COVID. But also, and I think more importantly, what's gone on in Saudi Arabia and Russia and China, right? They have their own motivated self-interest and they're worried about their own pocketbooks. And I will tell you, as evil as leaders of those three countries are, Xi is probably the least evil, right? I believe that. And he's evil. He's just less evil. I think that the Chinese are more trustworthy than Russia or Saudi Arabia at this point. And China is trying to stimulate. And they still have a decade or so before their demographics really catch up with them. Maybe even 20 years. So keep an eye on China. Keep an eye on the United States. And see if we're smart enough to figure something out on Taiwan and soften the relationship between the two countries. If we can do that, and then India gets, some growth too, this 15, 20-year super cycle up in the economy that I'm talking about could be spectacular. Well, as we all rebuild the world and decide not to shoot at each other. There isn't really a lot of reason to not be symbiotic with China, other than, they don't look like us or something, or they don't have our exact system. When the Chinese people are tired of the way China is run, the Chinese people will do something about it, right? That's how it works. Moonchild asked about gold miners. Let me look this up real fast. In Pig Latin, Ukfe gold miners. They're super heavy capex. You can trade them a little bit. But as I talked about in the last year, a number of times, I think that gold is the actual better investment, and it's not a great investment to begin with. So I've completely ignored gold for a year now. There's no point to it. Told you to sell it, never went back. We are close enough to normalization that even if the Fed backs off a little bit, gold's not going to get a big bid. But gold is getting harder to mine. That's bad for the miners. So if you want to own some gold bars and heirloom jewelry, which I've told you about 1,000 times, do that. And if you think that you can handle futures trading or options trading on the price of gold, have at it. Before over 90% of us just owning some little gold bars and gold coins and heirloom jewelry where you can get it. That's all. That's what your gold investment should be. Somebody says, if I could only buy one of the following, which would it be? We don't answer that question. All right. But they mentioned Unity, Stone, and Spire. They're completely different companies. There's no comparison of those three companies, Sandy. Everybody should own Unity. Everybody who's a growth investor should own the entire satellite basket. Do not try to outsmart the basket. Just buy Spire Global, Black Sky, Satellogic, and Planet. Just buy them. I have as much money in Black Sky now as I do in Planet. And then Satellogic and Spire Global are smaller positions. And then Stone is also, that is Brazil. If you don't want to use purely ETFs, I think Stone has tremendous upside. And I like the fact that they have the Berkshire investment, right? That is the warm cuddle on Stone. Somebody asked, how does the Fed affect Bitcoin and Marathon? In people's mind, there's a narrative that can drive the trade in a particular direction. I think these traders' narratives are garbage. I don't think that they matter for very long. They're just trying to explain something that they don't know enough about because it moved in a certain direction. On all of the Bitcoin stocks, the very simple, long-term, correct narrative is this. If Bitcoin is indeed a store of value and it's early in the adoption curve, those will all go up, probably a lot. And they'll probably go up more than the price of Bitcoin as a percentage, as we've seen with gold miners and gold. I don't think what the Fed does truly impacts Bitcoin. Not really. It's just a risk asset right now that's becoming an adopted store of value by the wealthy. During the adoption period is when people like us, or people who aren't thinking about millions and millions of multi-generational wealth that they might want to have cross borders, right? For us middle class investors, Bitcoin is a trade through the adoption period, from low adoption to high adoption. Right now it's at low adoption. When it gets closer to high adoption, higher up on the S curve, you'll want to dump all this stuff. And that's probably 2, 3, 4, 5 years out, maybe longer. Hard to know. But we do know that the family offices went from like none of them having any Bitcoin to a quarter of them having Bitcoin, and half of them saying that they're going to buy it. So you're going to get 75% adoption by the rich on Bitcoin, maybe by next year, right? Because there's enough trader narratives that don't make any sense. They just sound pretty. So, oh, Bitcoin might go down to 12,000 or 10,000 or 14,000 because my chart says so. And here's a reason why my chart says so. Nah, look, the chart says so. That's good enough. Look, it just has to do with cash flow, money flows, right? Everything has to do with money flows. Everything. It's supply and demand. It's basic. You don't have to go further than that. If the stock market is going up on low volume, that's bearish. If the stock market is going up on high volume, that's bullish. If the stock market is going down on low volume, that's bullish. And the stock market is going down on big volume, that's bearish. Pretty easy. It's just like the option chart, right? Buy, sell, calls, puts. There's really only 4 scenarios. And we just got a little rally in the stock market on low volume. It's bearish. And if the selling gets heavy, that's bearish too. Then when the selling turns light volume, that's bullish. You just pass through each one. So we got pretty big selling early in the year. The rebound rallies have been light volume. When the declines switch to low volume, that's when we really want to buy everything we can. And of course, the Fed tries to micromanage it on us. We'll see what they say. If they give us a fig leaf, maybe they're trying to get the bottoms to be in. They certainly are in on the small caps. And the emerging markets might have one level to go down if the Fed tries to tighten up even more. If the Fed is still hawkish this week, emerging markets have one more leg down. Maybe everything, and everything does really. So we'll see. I think they might throw us a fig leaf. I think they might say, we're not so sure about increasing the roll off. If that's what they say, then great. But if they don't say that, then I think September, October is, I think things are rough until September, October. But you still need to think like a buyer, because this is closer to the end than it is the beginning. The beginning was, 3 quarters ago. All right. Somebody asked about the launch of AST Space Mobile. Have they given a date yet for that? I don't think they've given a date. AST Space Mobile is a moonshot, literally highly speculative, but there's a lot of ways to play that. One way to play AST Space Mobile is just to own AT&T, because if AST Space Mobile's technology works, AT&T suddenly becomes a global telecom company all over the world. Anybody who wants an American telephone number, just hook up with AT&T. It'll still work where they are. Think that through. That's why I own AT&T. It's not because it pays a 5% dividend or whatever it is, and people keep focusing on the wrong stuff. It's that AT&T is going to start competing with Roku and might become a global telecom player. And even if they don't, they're still all right. They're not going anywhere. You can trim some up cycle someday, collect your dividend until then. But AST Space Mobile, that's a stock that could go up, I don't know, I think I have 50 times on the sheet. If that technology works, it is, yes, somebody used the proper term. The special unit of economic measurement is a shit ton. So the shit ton is a lot, right? So, all right, everybody, I'll let you go, and I'll get this edited up